There are very few places where you can get true passive income, where you can just throw your money at something and then forget about it, do something else, and keep getting checks every single year. One of the few places where you can get this type of passive income is in the stock market with dividends. And in this video, I'm going to be going over how you can replace your day job income with dividend income. The stock market is a place where you and I can go and invest in companies. Like if you really like Chipotle or you really like McDonald's, you can go and invest in these companies and buy shares in these companies, and then you become one of the owners of these companies. Then, once you are one of the owners of Chipotle or McDonald's or one of these companies, if they have a big profit at the end of the year, they will distribute some of this profit to their owners as dividends. You can think of a dividend essentially as a profit sharing check. If a company has a bunch of cash in their bank account at the end of the year, there's three things they can do with this cash. They can save it, they can buy back their own stock, which makes the stock price go up, or they can give this money to their shareholders, their owners, you, the people that own their stock, as a thank you for investing in their company. Not every company pays a dividend. Like, you're not going to see a lot of tech companies and growth companies, these startups, pay dividends, because these companies are investing every extra dollar they have back into their company because their goal is to grow as big as possible, as fast as possible. So the companies that pay dividends are typically your larger, kind of more stable companies. However, dividends, if you do them the right way, can be a great way to create a new passive income stream or even replace your current job income if you know how to do it the right way. So let's calculate how you can get enough passive income from your dividends. That way you can replace your job income. Now, before we do that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. All right, let's say you make $60,000 a year from your job. So if you want to replace your job income with dividends, you need to make $60,000 a year passively from dividends. Now, let's assume that dividends pay a 3% annual return a year. So for every dollar you invest in dividends, this company is going to pay you 3 cents in dividends. That means if you want to make $60,000 a year with this 3% return in dividends, you're going to need to invest $2 million right now to make $60,000 a year in passive income from dividends. Now, before you get angry and say, but Jaspreet, I don't have $2 million, let me go smash that thumbs down button. Well, we're not done yet. As you can see, this video has a lot of information left. If you wanted to go out and get the $60,000 a year in passive income from dividends today, and the stock is paying you 3% a year, then yeah, you're going to need $2 million in cash to buy shares of the stock. That way you can get a 3% return, which is $60,000 a year. But this isn't the only way to get this dividend money. Now, to get an idea of how much companies actually pay in dividends, let's take a look at some numbers. So AT&T pays out a dividend of 7% a year annually at the time of me recording this video. Verizon pays about 4% a year annually. Pepsi pays about 2.9% a year annually, and McDonald's pays a 2.5% dividend annually. That was just to give you an idea of what types of companies pay dividends and how big these dividends are, but you should never invest in a company solely because of the size of the dividends. I'll show you why. Let's say this hypothetical company is trading for $100 a share right now, and it is paying a $5 annual, let's write DIV, $5 annual dividend. So based off of this current share price, that means this company is paying a 5% annual yield, because for every $100 you invest, you get $5 a year in dividends. Now, let's assume that this company starts tanking. It does not do very well and it starts losing money, and the price of this stock falls from $100 a share to $50 a share. Now, if they haven't adjusted their dividend price yet because they haven't gotten to that point in the calendar year, then what you can see happen is they're still paying this $5 dividend because they haven't adjusted this yet. And based off of the numbers, they're paying a 10% annual dividend right now. But the part that you're missing is that this company has fallen from $100 a share to $50 a share because they're having internal problems, they're losing money, and maybe they're on the verge of bankruptcy. Who knows? So you should never invest in a company just because of what dividend yield they're offering, because there's a lot more to it than that. Sometimes a company's dividend is going to look artificially high because the share price has dropped drastically. So now back to the original question, how do you replace your income? So let's say this company is trading for $100 a share, and their goal is to pay out a 3% annual dividend. Well, off a $100 share price, that means they're going to have to pay $3 dividend. I'm going to do DIV, $3 per share for this dividend. So for every share you buy, you're going to get $3. Now again, if you wanted the $60,000 today, you're going to have to go in and buy $2 million worth of stock. but I'm going to assume that you don't have $2 million in your bank account to throw into this random company. The interesting thing about dividends is that they compound and they grow. Let me start by talking about how dividends can grow. When you invest in this company, if you paid attention to what I said earlier, you're not investing because of what their dividend price is. You're investing because of how strong the company is. You're investing because you believe in the strength of this company and what they're producing. Maybe they're innovating some new technology. Maybe they're creating some new guacamole that everybody wants. Who knows? They have this product that everybody wants that you think is going to grow. So let's assume you buy in at $100 a share, and then 5 years go by, and then this company starts to make more money. And what happens is over those 5 years, it goes from $100 a share to $200 a share. So now what has happened is you have already just doubled your wealth in the stock. You might feel pretty good here, but you have to remember, if this company is paying dividends, they might want to attract more investors who want to buy into this company because of their dividends. And if they're paying $3 a share for their dividends at a $200 stock price, that's not a 3% annual dividend, that's a 1.5% dividend. So if they want to maintain this 3% annual dividend, they're going to have to double how much money they're paying out in dividends too, which means now they're not paying $3 a share, they're paying $6 a share in dividends. But you didn't buy the stock at $200 a share, you bought in at $100 a share. So yeah, while the people that are buying it today are getting a 3% return on their money, you bought in here. So you're actually getting a 6% return on your money because you bought the stock for $100 a share, and now they're paying you $6 a year in dividends per share that you own. So if this company is making really good guac and the value of their company doubles, you're going to see the stock price double as well, which means you have just doubled your investment. But if they want to keep attracting these investors who are investing for dividends, they might have to raise the dividend price. And if they want to keep it at this 3% annual yield, they're going to have to double their dividends. But we're not done yet, because I want you to be a long-term investor, because the investors who make the most money are the people who have the long-term mindset. And so now let's assume this company continues to make new guac and they create these new guac variations, and now 5 years later this company doubles again. So now they're not trading for $200 a share, they're trading for $400 a share. And so for the people that bought here, yeah, they doubled their money, but you are now quadrupling your money because you bought in early. And so now let's look at the dividends. If they want to keep this 3% dividend yield because they want to keep attracting those dividend investors, what are they going to have to do? They're going to have to double this dividend price from $6 a share to $12 a share. You bought in when they were paying $3 a share in dividends. Now they're paying $12 a share in dividends. You bought in when they were paying a 3% dividend yield. Now it's going to be a 12% yield based off of the investment you put in initially. So if you bought into this company at this point and you held your stock for 10 years and the stock doubled twice and they wanted to maintain their same dividend yield, now you're making a 12% return on your money, not a 3% return on your money, which means you just 4x the amount of money you're making in dividends by doing nothing except holding the stock. And these returns really are not that unreasonable. Remember, we're talking about a 10-year span. So we're talking about a decade. It is not unreasonable to see a company double their share price twice over a span of 10 years. Is this guaranteed? No, of course not. Investing has risks. You are never guaranteed to make money when you invest. You might even lose money. Maybe this company will go bankrupt. But you are never going to make any money unless you take a risk. And this is not an unreasonable, never heard of returns. These type of returns do happen. But you have to remember, this is not something that happens over 6 months or a year. We're talking about a decade. Now, if we go back to the original example where your goal is to make $60,000 a year in dividends, originally it took you $2 million over here. If you bought $2 million worth, it would take you that much money in order to get a 3% return, which would give you $60,000 a year. Now, if the company you invest in follows this type of growth where they can double twice and the dividend value doubles twice over the course of you holding it, now you don't need to invest $2 million to get this $60,000 a year. You need to invest $500,000, $500,000, because now if you invest $500,000 at this price and the dividends go up to 12%, now this 12% return on $500,000 worth of invested cash is going to give you $60,000 a year. And now you might be thinking, Jaspreet, I didn't have $2 million to invest to get the $60,000 a year, and I also don't have $500,000 sitting in my bank account to invest to get the $60,000 a year. Well, we're not done yet. I'm going to show you how you can scale up your investments slowly. That way you can get this goal of building this income stream from dividends. That way you can replace your job income. It is not something that happens overnight. This is a long-term process. So let's talk about how you can scale your investments up. But before we do that, I want to talk very briefly about how you actually get dividends. In order for you to get these type of dividends, you have to invest in companies on the stock market. And in order for you to do that, you have to use a stock brokerage that lets you invest in companies. And you also want to make sure that the stock brokerage also lets you reinvest your dividends automatically. That way you can accelerate your growth. So we talked about how dividends grow, and we talked about how you can invest in dividend stocks. Now let's talk about how dividends can compound. So we're going back to this hypothetical example of a company trading for $100 a share that's paying $3 per share in dividends, which is a 3% return. If you come in and you buy $5,000 worth of the stock, that means you're buying 50 shares. So if you buy 50 shares and each share pays a 3% dividend, that means after 1 year, you are gonna make $150 passively in dividends. Now, when you get this $150, I hinted at this a minute ago, there's two things that you can do with this $150. One thing you can do is go out and eat a nice dinner. So I'm gonna draw you a nice plate of food. This does not look like food, but this is a nice plate of food. So you can go out and use this $150 and buy some dinner. I'm clearly no Bob Ross. The alternative, what you can do, is you can take this $150 and use it to buy more shares of the stock. Well, I guess this arrow should go over here to the number of shares you have, but you can automatically have this money that you just got to go out and buy you more shares of the stock. Now what's going to happen is you're not going to have 50 shares of the stock, you're going to have 51 and a fraction shares, because if you use something like our sponsor M1 Finance, you can buy fractional shares of a company, which means next year, if assuming the stock price doesn't change, you're not going to make $150, you're going to make more than $153. $3 or $4 might not seem like a huge difference in the scope of 1 year, but you have to remember, we're doing a few different things here. First, we're going to be buying shares of the stock every month or every week, okay? So you're going to be accumulating more shares consistently. Second, we're buying into a company that we believe in for the long term. So we're hoping that the share price is also going to increase, which would also drive this dividend price up. And third, the money you make from dividends every year is also going to be buying you more shares. So that means you're accumulating more shares three ways. You're going to be accumulating more shares just because every month or every week you're putting more money into this investment. That way you can accumulate more dividends. Second, every time you get paid from dividends, you're going to be using this money to buy you more shares. And third, assuming that share prices go up and you get bigger dividends, you're going to make bigger dividends, which allow you to buy back more shares too. So the name of the game now is accumulating equity or shares or ownership in this company, because you believe in this company, and the more ownership you have in this company, the bigger the dividends are that you get. So when you combine these three things, first, you're investing into a company that you believe in, which will hopefully cause appreciation in the stock price, which will make your investment more valuable and will hopefully drive your dividends higher. Second, every time you get paid dividends, you're reinvesting this money to accumulate more shares. And third, every week or every month, you're using more money to buy more shares of the stock. So every time you get a paycheck, a little portion of your paycheck is going to go to buy you more shares of the stock. That way you can accumulate more equity, more ownership. That way you can get more dividends. If you do that, you're not going to need $2 million invested to get you this return because of all the things I just talked about. You're not even going to need the $500,000 figure that I talked about. If you do this, you will be able to reduce the amount of cash that you need to do this, to get this income that you need to replace your day job income by another 10% or 20% or 30%. But the key is this is a long-term play. This isn't something that's going to happen in 6 months or a year. This is something that's going to happen over the course of 10, 15, maybe 20 years. And you're going to see that real growth towards the end, because then you're going to be able to accumulate more shares much faster. It starts with your mindset. The goal is long-term wealth creation, and in order to do that, you need to accumulate equity or ownership in this company. If you've been looking for specific places to invest your money to build your wealth, well, look no further, because in this video, I'm going to be going over some of the best ETFs to invest in to make some money. Investing in the stock market isn't always easy. I mean, the stock market is the most accessible place for somebody to go and invest their money to build wealth, but at the same time, so many people lose their money in the stock market because they either don't know how to invest their money in stocks, they don't know how to research stocks, or they get emotional, they buy a stock, they see it go down a little bit, and then they sell at a loss, and then a few weeks later, the stock pops back up. I knew I shouldn't have sold! If you don't want to spend all of your time researching stocks and picking stocks and keeping up with stocks, then another thing that you can do, instead of just trying to invest in individual stocks, is invest in something called an ETF or an exchange traded fund.
An ETF, you can kind of think of it like a basket of stocks, a group of stocks. Now what you're doing is instead of trying to find the perfect company to invest in, you're investing in a group of stocks, which gives you exposure to a whole bunch of stocks. Now, if one of the companies in your ETF goes bankrupt, well, you're okay because your ETF will have hundreds of other companies to make up for that loss. So even if one company goes bankrupt, it's not a big deal. But if you invest in one company and this one company that you invest in goes bankrupt, now your entire investment is gone. The nice thing about ETFs is it makes investing a lot more passive for you because now you don't have to keep up with every individual company. You just find the right ETF, you throw your money in there, and you keep investing your money every week or every month. And now you're just consistently building up this portfolio of this ETF or ETFs that you like. And this ETF is doing all the work to invest your money for you. Plus, ETFs work just like stocks. You can start investing in ETFs with as little as $100, and you can buy or sell your ETF whenever you want. But the whole idea about investing your money in ETFs, just so you know, is you want to be investing for the long term. So we're talking years now where you want to buy something and you want to just keep investing in it and hold it for the long term. That way you allow the market to grow and your companies to grow to make you more money. Now, the thing that makes ETFs really interesting is you have different types of ETFs that give you exposure to different types of stocks. And in this video, I'm going to be going over 7 different types of ETFs with different ETFs within each type, that we can understand some of the best ways that you can go out and start investing your money and building wealth. So let's jump into these 7 types of ETFs. But before I do that, I need you to do me a quick favor and smash the thumbs up button below. And just so you know, if you are interested in learning more about how you can start investing in the stock market and start building wealth in the stock market, our team has put together an amazing guide on how to invest your money in the stock market. This guide will walk you through different stock market strategies and how to invest your money in the stock market and build wealth in the stock market. This guide is completely free when you sign up for our daily newsletter. So if you want to read our free stock market investing guide, I'll put the link to how you can download this guide in the description below. The first and probably the most popular group of ETFs are the ones that give you exposure to the S&P 500. So the S&P 500 is just the largest 500 companies in the United States that trade on the stock market. So if you are a company and you are one of the biggest 500 companies on the stock market, well then you are gonna fall into the S&P 500. So this is literally just an index or a group of the biggest 500 companies on the stock market. A couple ETFs that will give you exposure to the S&P 500 are VOO and SPY. Small disclaimer, I do own shares of VOO. Now what you need to understand about this is when you go out and you buy shares of VOO or SPY on the stock market, this is now an ETF. So when you buy either one of these, you're getting exposure to the 500 largest companies on the stock market. Now you don't have to go out and individually buy each company. These ETFs are out buying these 500 largest companies and they're managing that investment for you. So all you have to do is invest your money into here or here, and now you have exposure to the 500 largest companies on the stock market. Now, before I go any further, I gotta make sure this is clear. Investing money has risks. You are never guaranteed to make money when you invest. You might even lose money, so always do your own due diligence and never blindly listen to a random guy on YouTube. Everything that I'm talking about today are just examples. I'm not telling you what to invest in, and I'm not telling you where you need to invest. I'm giving you examples of how these ETFs work and a couple ETF examples that way you understand where to look. But I want you to do your own research because there are a ton of ETFs out there, so you gotta find what's right for you. So the thing that differentiates these 2 ETFs is one, who manages the ETFs, and then what this ETF actually invests in and how much. So this is a Vanguard ETF and this is a Spider ETF. What that means is Vanguard, the company, is the one that owns and manages this ETF, and Spider is the one that manages this. By the way, just so you know, Spider is spelled SPDR. Now, when we talk about what companies an ETF is invested in, you want to look a little bit deeper than just the companies, because what's going to happen is both of these ETFs are both going to be invested in the biggest 500 companies in the stock market, but one might be invested more in Microsoft than Apple, the other might be more invested in Tesla, and so they both give you exposure to the top 500 companies, and this is where you can do a little bit of research and see how much each ETF is invested into what. One of the easiest ways to do that is just to go to finance.yahoo.com, and then you can just enter in these 2 ticker symbols, and then you'll see, if you scroll down, you'll see some of the top companies that each of these ETFs are invested in, or you can go onto the Vanguard website or the Spider website, and they'll show you which companies these ETFs are invested in and how much. That way you can get an idea of which companies you're getting exposure to. Another thing that you can pay attention to when we're comparing different ETFs is the expense ratio. The expense ratio, if you go to finance.yahoo.com, you'll see it there. You'll also see it on both of these websites. This is how much money you are paying to have your money managed by this ETF. So the advantage with an ETF, especially a low-cost ETF, is you're going to pay way less money to have your money managed here than to have somebody physically managing your money with an actively managed portfolio. So these type of ETFs, these are passively managed, meaning they're managed by a computer. So all these ETFs are doing is they're giving exposure to the top 500 companies in the stock market. If one of the companies in these top 500 companies goes bankrupt or gets smaller, well then this ETF or this computer is just gonna kick out that company and it's gonna put in the next biggest company. That way your money is still being managed by the computer, but it's like an algorithm. It's gonna give you exposure to the 500 biggest companies. The expense ratio on both of these ETFs are very low. It's less than 0.1%, which means if you invest $10,000 into one of these ETFs, they're gonna charge you less than $10 a year to manage your money. But that expense ratio is definitely something you wanna remember as you start comparing more and more ETFs and as we go deeper in this video, because you're gonna learn about different types of ETFs. And so if you're trying to compare different types of ETFs and see what's better for you, the expense ratio is something you should be paying attention to. The second type of ETF that you might wanna consider is a total stock market ETF, kind of like VTI. So a total stock market ETF gives you exposure to the entire stock market. Previously, we talked about the S&P 500 index, which gives you exposure to the 500 biggest companies in the stock market. Something like VTI will give you exposure to the entire stock market with big companies, medium-sized companies, and small-sized companies. So now you're literally just investing your money in the stock market, and if the stock market goes up, your ETF should go up. The stock market goes down, your ETF in general should go down. So now you're essentially giving yourself exposure to the entire broad market. This is another Vanguard ETF. And the thing you gotta understand about this is if you don't know what sector to invest in or what industry to invest in or kind of a more generalized place to invest, then this might be a good place for you to invest because now you're just investing your money in the stock market and you're hoping that the stock market will go up. So if you believe in the United States economy, then you should be believing in the United States stock market, which means that in the long term, the United States stock market should go up. And if it does go up, well then this ETF will give you exposure to that. The third type of ETF that you want to consider are high dividend yielding ETFs. So there's two ways that you can make money in the stock market. You can make money through appreciation, which is when you invest your money in a stock, you bought it for $100 a share, and then the price of the stock goes up to $200 a share, and then you sell. You just made $100 because the price of your stock went up. This is called appreciation. But the second way that you can make money in the stock market is through something called dividends. So at the end of the year, some companies have a lot of cash in their bank account. And when a company has a lot of cash in the bank, there's a few things that they can do with this money. They can save this money for emergencies, they can invest this money back into the company, or they can pay this money back to the investors. They can literally just give it back to you in a cash payment called a dividend. A good company should do all three. So a good mature company is gonna save some money for emergencies. They're gonna keep investing in their growth. They're gonna hire more employees. They're gonna open more offices. They're gonna open more stores. And then they want to reward their investors, their shareholders, people like you for investing in and believing in the company. So this is where you have to understand what stage a company is in to be able to pay out a dividend. Because if we're talking about a small startup growth company, well, this company's goal is probably not going to be to reward their investors because their goal right now is to get as big as possible, as fast as possible. So what they're going to be doing is not saving their money. What they're going to be doing is not paying this money out to their investors. What they're going to be doing is taking all of their cash and more through debt and other investments, and they're going to be reinvesting it back into their company. They're going to want to get more users. They're going to want to get more customers. They're going to want to open more stores. So smaller startup companies are not going to be paying out dividends because they want to get as big as possible, as fast as possible, and every dollar that they have is going to be going right back into their company. But some companies, your more mature companies or larger companies, are going to have this extra cash pile because they're already very large. And at the end of the year, they're going to have a huge profit. And if they want to pay this money out to their investors, one way they can do that is through dividends. It's an actual cash payment that you get without even selling your stock. Now again, there's a couple ways that you can get exposure to these dividends. You can go out and you can individually invest in companies that are paying out high dividends, or you can invest in a dividend paying ETF. So if you invest in a company that's paying out a high dividend, well, now the pro is you'll be able to get a high dividend, and if you invest in a good company, the value of your company will go up. But now the risk is if this company starts to tank, if they are on the verge of bankruptcy, if they start losing money, well then they're going to be forced to cut their dividend and you can see their stock price crash. The advantage of an ETF now is now you don't have to worry about trying to find the perfect company again because ETF is going to give you exposure to a whole bunch of different high dividend paying companies, And now if one company tanks or goes bankrupt, you'll be okay because you're getting exposure to a wide range of companies. The con here is you're not going to get the highest possible dividend because some companies are going to pay a higher dividend than others, and your returns are also going to be averaged out because some companies are not going to do well, but other companies are going to do great. So the goal with an ETF is not to get the best return possible, it's to get a slow and steady, consistent return through the market. A couple examples of ETFs that are focused on paying you dividends are VYM and RDIV. Again, these two ETFs are in the business of trying to get you high dividends. This is where, again, you have to know what your goal is as an investor. I know I've talked about this at least 100 times on our YouTube channel, which is why if you haven't subscribed to our channel, make sure you do that. But this is where you got to know your goal, because if your goal is to see your investment portfolio grow as big as possible, then you don't want to be investing in these high dividend ETFs because these companies are now taking their money and paying it out to their investors instead of taking their money and reinvesting it back into their company. So what you want to do, if your goal is to see your portfolio grow as big as possible, as fast as possible, is not invest into these dividend paying companies. These ETFs are focused on producing you consistent cash flow. It's not going to be the highest cash flow possible, but their goal is to give you consistent cash flow that you can count on. Like what we saw happen in the 2020 pandemic was a lot of companies started to struggle. And because of that, lots of companies started pulling back their dividends. And so people who were invested into these companies that were paying out dividends, hoping for consistent cash flow, were then all of a sudden, almost overnight, left with no more cash flow coming in because lots of companies cut their dividends. And so the whole idea here is to get a safer, which also means lower return, but a safer, more consistent dividend income. The next type of ETF that you may want to consider investing in are emerging market ETFs. The whole idea behind this is, well, now you want to diversify your money outside of just the United States, because the reality is every economy has its own struggles and no economy can continue booming at a consistent rate forever. The United States is the leading economy in the world. The United States is the strongest economy in the world, but some people are naturally worried that another company is going to come around and their economy is going to grow bigger than the United States. Or they're also thinking that smaller countries around the world are growing faster than the United States right now, which makes sense because smaller companies grow faster than bigger companies. When you're this large, big behemoth of a company, it's much harder for you to invest in innovation and grow much bigger because you're already very large. But if you're a small company, well, now you have the ability to grow way bigger faster because you're small, and so you have a lot of opportunity to grow. It's the same with this here. When you're investing in emerging markets, the whole idea is you're taking on a little bit more risk because you're investing in new countries, things like China and India and Brazil. And what you're hoping for here is that these smaller countries are going to see economies that are going to grow faster because they're smaller and they have the opportunity to grow bigger. Plus, you naturally have some people that are a little bit worried about the long-term health of the United States economy. So they want to diversify some of their money outside of just the United States economy. And one way that you can do that is by investing your money into emerging market ETFs, because this gives you exposure to the economies of different countries around the world. Again, a couple examples of this would be VMO and IEMG. These are two different ETFs that give you exposure to emerging markets. Now again, this is where you want to do a little bit of your own research and see which countries each ETF is investing in and see what you'd rather have. Do you want more of an exposure to China, or do you want more exposure to South Korea? And so you just gotta figure out what's important to you, because this ETF is going to give you more exposure to China. This ETF is going to give you exposure to a broader range of countries. But now we're just getting into the details, because in either case, you're going to be getting exposure to emerging markets and emerging countries around the world to give you some diversity outside of just the United States itself. The fifth type of ETFs that you may want to consider investing in are innovation ETFs. We are in the innovation age right now, where technology is growing and innovating way faster than we've ever seen happen before. I mean, for all the 80s and 90s babies out there, you probably remember that when you were a kid, the internet wasn't what it was today. When you had to go on the internet back when you were a kid, you had to make sure that your mom or your dad wasn't on the phone because you had to go through dial-up, and anytime you went on the internet, it was like, you remember that whole sound bite that you had to go through to get on the internet? Well, now look at how far we've come with innovation. And so if you want to invest your money into the future of innovation, then you can look at innovation ETFs. So some of the most popular innovation ETFs are managed through the ARK fund, which is managed by somebody named Cathie Wood. And Cathie Wood is now a famous investor because of the returns that she's gotten her investors. And just a disclaimer, I do have my own money invested in a handful of different ARK funds. But the whole idea behind these ARK funds, their symbols are all ARK, ARK. K and then something. Like ARK K is their flagship innovation fund. If you put in a G here, it's the Genome Fund. If you put in an F here, it's the FinTech Fund. They have a fund for space exploration. They have a fund for a lot of different things in the innovation space. You can just go onto the website and see the different funds that they are. But again, the whole idea here is you are trying to get some exposure into the innovation side of the world. Another thing that you want to understand about these is that these funds also come with their own fair share of risk because you're investing in a lot of smaller companies and a lot of startup companies. And these funds are also more on the actively managed side, which means that you have people actively working to try to find the best companies to invest in. And so your expense ratio, remember we talked about that a little bit earlier in this video, is going to be a little bit higher here because now you're actively paying somebody to help manage this fund. But if you're one of those people that wants to be invested into the innovation side of things, into the newer companies, into the newer technology, and you want to hope that one of these smaller companies takes off, well then some of these ETFs might be right for you. The sixth place where you may want to consider investing your money in ETFs are REIT ETFs. I didn't write the word ETF. REIT ETFs. And what a REIT is a real estate investment trust. So for all of my real estate people that want to get exposure to real estate on the stock market, this can be a way for you to get exposure to that by investing your money in REITs. When you invest your money into a REIT, you're investing your money into a company that invests in real estate or that invests into mortgages. So you're not getting direct exposure to the real estate per se, but you're investing in the company that invests in real estate. So the whole idea is if real estate goes up or if real estate is really booming, well now this company is going to be booming because it's investing in real estate and you're investing in that company. So it's not a direct investment in real estate, it's an investment in the company that invests in real estate. A couple examples of REIT ETFs would be VNQ and IYR. Now the thing that makes REITs interesting is REITs are required by law to follow something called the 90% rule, which says that REITs are required to pay out 90% of their taxable income or their profits to their shareholders, people like you, through dividends. And so a REIT's income comes through rental income, because these REITs own these rental properties, these investment properties, and they make money from rent. And then after they pay all their expenses, their management fees, their property insurance, their utility bills, their property taxes, their other fees, once they pay all their fees, then they take the rest of this income and 90% has to be paid out to people like you, shareholders, through dividends. An ETF's job, again, is to minimize the risk for you. So now instead of you trying to find the best REIT to invest in, now you can invest in a REIT ETF. That way we get exposure to a whole bunch of different REITs that we don't have to worry about trying to find the perfect REIT to invest in, because REITs do have a lot of volatility, especially the ones with the higher dividend yields. And this brings me to the seventh type of ETF that you might want to consider investing in, which are your growth stock ETFs. These are your companies that are trying to grow as big as possible, as fast as possible. And then within these growth stocks, you have your large growth stocks and your smaller growth stocks. Your larger growth stocks are a little bit more mature. These are your companies that might be making profits, that might be paying out small dividends, but they're still really investing in their growth. They're still investing a lot in innovation because they still want to grow bigger. So the first example of this would be investing in something like QQQ. So QQQ gives you exposure to the NASDAQ, which is essentially the 100 largest companies which are not financial. So these would be companies like Amazon and Apple and Microsoft and Tesla. A lot of these companies are tech companies, but when you're investing in QQQ, you're getting exposure to 100 of the largest non-financial companies, which many of them are in the tech space. On the other hand, you also have the small cap growth stocks where you can get exposure through something like SYLG. So SYLG invests into the smaller cap growth companies, and these are going to be a lot of companies that you might not have heard of. A couple popular ones are things like Crocs and maybe MicroStrategies, but the goal with both of these ETFs are to give you exposure to these growth type of companies. One gives you exposure to the larger cap ones. These are going to be more of the companies that you've already heard of. This one gives you exposure to the smaller cap companies, the smaller companies that are really fighting to become much bigger. Remember, more risk comes with more potential return, but you also have more chances to lose your money. This again goes back to your goal. What do you want? More risk comes with more potential return, but it also comes with more risk. Less risk compared to this comes with less potential return, but also less risk. Now, the key for any of these investing strategies to work that are discussed is you have to stay consistent and you want to keep investing your money, whether it's every week or every month. You want to keep investing your money into these ETFs. That way you can continue to build your portfolio of these ETFs. That way you can keep fueling the fire. And then you want to make sure that your fire has time to grow. The best way to build wealth in the stock market is to leave your money in the stock market for the long term, because the people that make the most money in the stock market are the people that invest for the long term. And remember, if you do want to learn more about investing your money in the stock market and some of the different stock market strategies out there, we got a free guide to investing your money in the stock market in the description below. Mutual funds, index funds, and ETFs are 3 ways that you can invest your money in the stock market, but they can come with very different investment results. What's up, everybody? I am Jaspreet Singh from theMinorityMindset.com, where money minds rethink rich. When I invest my money, there's 2 things that I always look for. I look at how much risk is involved, and I look at how much money I can potentially make. If I was gonna invest $10,000 and I had to decide between investing this $10,000 into my broke cousin Bunty, who's on his 34th business idea, or investing this money into Amazon, who's established and has a business plan and is very successful, I'm going to expect very different returns to justify my investment. Bunty is a risky investment, so I'm going to need bigger potential returns to justify me giving him my cash, because as soon as I give him that $10,000, there's a good chance that he's going to invest that money into a new Gucci wardrobe. I gotta look good for the business. Deciding between investing your money in my cousin Bunty or Amazon is pretty obvious. I'm gonna invest my money in Bunty. But what if you had to decide between investing your money between Amazon and Apple and FedEx and Verizon and McDonald's and Microsoft? Who's gonna give you the best return for your risk now? Not so easy anymore. There's 3 different ways that you can take this. Option 1 is you can spend all the time researching these companies, and you might decide that Apple is the best company to invest in based off of all your research, and now you invest all your money into Apple. This one has the most risk because now if Apple releases a really bad iPhone and people start hating Apple products and their company tanks, well, down with it goes your money. It also comes with the most upside because now if you're right and Amazon wins big, then you're gonna win big. Option 2 is now you can open up a stock brokerage, and instead of just investing in one company like Apple, you can invest in every one of these companies. That way you're lowering your risk. If you do want to learn more about how to actually open up a stock brokerage and invest your money in stocks, our team wrote an article on our website, theMinorityMindset.com, that walks you through how to do that. So if you want to read that article, I'll link it for you in the description below. This one requires more work because now you're not just managing and monitoring one stock, you got to manage and monitor a whole portfolio of your stocks. Or option 3 is you can pay a small fee and then you can invest in a fund like a mutual fund or an index fund or an ETF, and let these funds invest in all these companies for you. So now instead of you going out and investing in all these companies, you invest in a fund that gives you exposure to all these companies. Well, all 3 of these funds give you exposure to the stock market. They work in very different ways, which can affect how much money you make, which is why you want to understand the differences. And that's what I'm going to be going over in this video as soon as you fund that thumbs up button below. Let's start with mutual funds. Mutual funds are known as actively managed funds. And to understand how they work, let's assume for the sake of this example that this is a mutual fund that's made up of only 4 stocks. A lot of times mutual funds will have way more stocks, sometimes hundreds of stocks, but just to keep things simple, we're going to assume that this mutual fund only has 4 stocks. If you wanted to invest in McDonald's, Tesla, Apple, and Amazon, one thing that you could do is you could go out, open a stock brokerage, and individually invest in McDonald's, Tesla, Apple, and Amazon. But now you have to decide how much of your money are you going to allocate towards each stock and what stocks do you want to own. On the flip side, when you invest in a mutual fund, you have this person right here. We're going to call this person a money manager, and we're going to draw him a nice mustache. This money manager is who you're trusting. So you're going to give your money to this money manager, and this money manager is going to create this fund. So this person is managing this fund, and when this money manager likes a stock, they're going to buy it. When they don't like a stock, they will sell it. So maybe right now this money manager likes these 4 stocks, but some time goes by and he's like, you know what? I don't like McDonald's anymore. We're going to replace them with Chipotle. So now he's monitoring the stocks and he's actively buying and selling based off of what he thinks is going on in the market and based off of what he thinks is going to make this fund more money. The whole point of a mutual fund is to have a really smart money manager with the goal of this money manager being able to beat the general stock market. So you are hoping that by paying this money manager a fee, you are going to be able to outperform the stock market, which in turn will make you more money. You're also getting the benefit of passiveness because now you're not having to go out and individually invest in all of these companies and manage each one of these companies. You have a money manager who's going to do that, and you also have the benefit of diversity because now this money manager is diversifying your money into different companies. If you want to invest your money into a mutual fund like this, you can expect this to cost you something like 2% a year on all of your assets. What that means is if you deposit $100 into your mutual fund, this money manager is going to take $2 a year to manage your $100. So if you invest $1,000, that's $20 in fees, and if you invest $100,000, that's $2,000
$2,000 a year in fees. Now, while 2% might not sound like a lot of money, it does add up, especially as your money grows and compounds. Like if you started investing $500 a month today and you were paying 2% a year in fees and you were able to get an average 7% return on your money, over the next 30 years, you're going to end up paying something like $166,000 in fees to your money manager just to invest your money. Now, look, I'm a value person. If you can make me an extra $1,000, I will gladly pay you an extra 2% in fees. So if you can make me more money, I will pay you more money as long as I continue to come on top. The only issue with this is what we've seen over the long term is these mutual funds don't always outperform the market. Actually, a lot of mutual funds can't even meet the returns of the general stock market over the long term. Like Warren Buffett was so confident in this that he made a $1 million bet that the general stock market, the S&P 500, would be able to outperform a number of hedge funds. These are highly sophisticated, highly expensive hedge funds. And over a course of 10 years, the hedge funds did well, but they did not even meet the stock market returns. So then the hedge fund owner had to then pay Warren Buffett $1 million because he lost the bet, and Warren Buffett took that $1 million and he donated it to charity. I'm gonna go over how you can get the general returns of the stock market without paying these high fees, but in general, a mutual fund's goal is to be able to beat the market. That's why you're paying these fees to a money manager. That way you have somebody who can hopefully beat the market. The only problem with that is a lot of times you will not beat the market. Sometimes you will, sometimes you won't. It's really hard to predict because it's hard to beat the market, especially over the long term. This is not to say that mutual funds are never the right answer. I mean, there are some really good mutual funds out there, but a lot of these really good mutual funds are reserved for super high net worth people. Like you need at least $500,000 to get into some of these mutual funds versus some of the regular mutual funds that you're just paying 2% on. You could get a better return without paying all the fees. Second, let's talk about index funds. So the whole idea of index funds came about by this company called Vanguard. And Vanguard said, you know, what if we could let people invest in a group of funds like this without paying these super high fees? Well, the only issue with that is you need to pay this money to a money manager. So if Vanguard wanted to create this index fund where you can invest in a fund without paying all these fees, they also had to get rid of this person with a mustache right here. And instead what they did was they replaced that person with a mustache with a computer who automates this investments. Now you're investing in a fund, a group of companies, but instead of having a money manager decide which companies are in this fund, you're going to have a computer decide. So you create an algorithm. What are the type of companies you want to invest in? You punch that into the computer, and then the computer decides what company fits that fund. For example, I just talked about investing in a fund that gives you exposure to the S&P 500. The S&P 500 is an index, meaning it's a group of stocks that gives you exposure to the top 500 companies in the stock market. Now, one thing you can do is go out and individually invest in all 500 of these companies, but that's going to take a lot of work and a lot of management headache. Or you can invest in an index fund that gives you exposure to all 500 of these companies. That's what Vanguard allowed you to do. Now you can just invest in this index fund, and that gives you exposure to these top 500 companies. So now you're getting exposure to the general stock market without paying all the fees. VFIAX is the Vanguard index fund that gives you exposure to the general stock market. So Vanguard is the company that created this index fund. There's a bunch of banks and a bunch of companies that create these type of things. Vanguard is just one of those companies. It was the first to create index fund. So Vanguard has this index fund, which is a group of stocks that gives you exposure to the top 500 companies. If you want to know how much fees these index funds cost, all you got to do is search it on Google. So like with this VFIAX, you can see it says in the title that this is the Vanguard 500 Index Fund Admiral Shares. It has the word index fund in the title, so you know it's an index fund. And over here, you can see something called the expense ratio. This expense ratio is how much money you're going to be paying in fees. That's what you want to pay attention to. 0.04% in fees means that for every $100 you invest, you're going to be paying 4 pennies in fees. Compare that to the 2% fee you'd have to pay with a mutual fund where you're paying $2 out of every $100 you invest. So the fees with an index fund are way less because now you substituted that money manager with a computer, and computers are a lot cheaper to maintain than people, especially if they have a mustache. What you have to understand about index funds is a lot of them have a minimum investment. Like this Vanguard index fund has a minimum investment of $3,000. So if you don't have $3,000 to invest, you cannot invest in this index fund, and you also can't just buy and sell this index fund whenever you like. Index funds like VFIAX only let you buy and sell this index once a day. So if you're trying to trade index funds and mutual funds, that's not the way to go because you can't just buy and sell an index fund whenever you want. You can only do that one time in the day, and typically it happens at 4 p.m. as soon as the market closes. But if you're looking to be a long-term investor, it really shouldn't matter too much because now you're looking to invest for the long term. You're not looking to invest for 2 hours. And so what happens now is you're not going to see people trading these index funds every single day because you just can't do that. The alternative to investing in an index fund like this is investing into an ETF, which stands for an exchange traded fund, because ETFs that you buy and sell these funds kind of like stocks. You can buy and sell these ETFs whenever you want, and some index funds have ETF versions of them too. Like if we go back to the Vanguard website, you'll see that this index fund also has an ETF version. It says it right below the title. Also available in an ETF. If you click that button, it will take you to the ETF version of this index fund, which is VOO. VOO is an ETF that gives you exposure to the S&P 500, so the top 500 companies in the stock market, and this has an expense ratio of 0.03%. You can find this the same way you find the expense ratio of an index fund. Just search it on Google, and on this website, it will tell you what its expense ratio is. That's how much money you have to pay in fees every single year. So here, if you invest $100, you're going to be paying 3 cents a year in fees, so almost nothing. But unlike an index fund, you can buy and sell shares of VOO every single day whenever you want when the market is open. Remember, with the Vanguard Index Fund, you had a $3,000 minimum investment, and those transactions only happen once a day. With VOO, you don't have a minimum investment. All you have to do is buy 1 share of this ticker symbol, and then you can buy or sell VOO whenever you want throughout the day. So between this Vanguard ETF that gives you exposure to the S&P 500 and the Vanguard Index Fund that gives you exposure to the S&P 500, they both charge you essentially the same fees. They both invest in the same companies. The difference is VOO, you can see the real-time price throughout the day, versus the index fund you cannot. VOO does not have a minimum amount of money you have to invest versus the index fund you do. However, the index fund allows you to automatically invest or withdraw your money versus this ETF does not. So if you invest your money through Vanguard, you can automatically reinvest more money every single month through Vanguard, versus with this ETF, you cannot do that. So if you're looking for a passive way to invest your money, the index fund gives you the benefit because now your money can automatically be invested every single month without you having to do anything, versus you can't do that with an ETF unless you're using a brokerage that can passively invest your money for you. The whole reason for you to invest your money into these passive investments is to see your money passively grow and compound over time. But if you want to see your money really compound quickly, you got to keep adding money to your investments. And the simplest way to do that is every single month, just add more money into this fund. So if you invest your money into the index fund, that can automatically happen. You can't do that with this unless you use a brokerage that automatically pulls money out of your savings account or your checking account, and they invest this money into your fund. If you want to learn more about how to do that, our team put together an article that breaks down the basics of investing, and I'll link it for you in the description below. So ETFs work almost the exact same way that stocks do, because you can buy or sell shares of an ETF the same way you do a stock. You can see the real-time price of an ETF the same way you can do a stock, and you don't have a minimum investment you have to invest minus the share price the same way you do a stock. Index funds, on the other hand, can give you exposure to all the same companies, and they let you do the automatic investing too. When it comes to your money actually being invested in an ETF or an index fund, there's an algorithm that tells the computer which company should be in your fund. So if you're investing in this ETF or in this index fund that gives you exposure to the top 500 companies, now what this algorithm is going to look at is which companies are in the S&P 500. If one of the companies in here, so let's assume Tesla for the sake of this example, tanks, and Tesla stops making money and their market cap decreases, then what this index fund will do is say, okay, Tesla is no longer in the S&P 500. They're no longer one of the top 500 companies or the biggest 500 companies. So they're going to kick Tesla out, and they're going to put in whatever the new company is that replaces Tesla. So it happens passively. You don't have to do anything. This happens in your index fund for you. And because this is happening through an algorithm, through a computer, you get to pay way less fees. So between mutual funds, index funds, and ETFs, which one can make you the most money? Well, before I say that, let me just remind you that investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. In general, for the majority of people, there's always going to be outliers and exceptions to the rule, but for the majority of people in general, index funds and ETFs are going to be the better way to go, because now you're going to meet the stock market returns and you don't have to pay the super high fees. Now, obviously, there are some mutual funds that are going to do great. There are some mutual funds that are going to greatly outperform the market, but there's a chance that you might not get that mutual fund. there's a chance you're going to pay the high mutual fund fees without even getting the market returns. So if you believe in the American economy, then you're going to believe in the American stock market, which means over the long run, the stock market will continue to go up. And if that's the case, then you can just get the consistent returns of the stock market by investing your money in the general stock market, by investing in an ETF or an index fund that gives you exposure to the general stock market. Between an ETF and an index fund, this is really personal preference. I mean, do you want to have the automatic reinvestment into an index fund, or do you want to just invest your money into a brokerage that can automatically invest your money for you? Personally, I like ETFs because I like the freedom that comes with them. The key to succeeding with any of these is really just consistently investing your money month after month after month and keeping your money in the market for long enough. History has showed us that the stock market and the economy always goes up. That doesn't mean it'll always go straight up. Sometimes it will come down, sometimes it will crash, and sometimes it will correct. But over the long run, it will continue to go up as long as the economy keeps growing. So if you believe in the American economy, then this is a way for you to get that upside without actually starting your own company. There are 7 habits keeping the majority of Americans financially poor. And if you stick with me until the end of this video, not only are you going to understand what these habits are, but you're going to understand what not to do, that way you can continue building your wealth and not end up like the majority of Americans. Number 1 is you drive a car so expensive that you can't afford the gas. Yesterday, I was on the phone with somebody who works with me out in Miami, and what she was saying is the funny thing about Miami is this is the only place where you'll see people driving around in Lamborghinis who can't afford to pump their own gas. At the time of me recording this video, the average used car payment in the United States is $528 a month. And the average new car payment in the United States is now $729 a month. That means that Americans are paying a record amount of money, not just to buy the car, but to finance the car month after month after month. But let's really understand what this means, because now what you're doing is you're paying this money every single month to drive a car. And if you have a nice car, you got to pay for the premium gas, which is a lot more expensive than the regular gas. And if you drive an expensive car, you also got to pay for the expensive insurance. And then you got to pay for the expensive maintenance. Because guess what? German cars have much more expensive oil changes than non-German performance exotic cars. So now not only are you paying more money in your car payment, but you're paying more money in gas and your insurance and your maintenance and your oil changes and anytime something goes wrong. But what happens now to your actual car payments? Because all this money that you're sending to your car payment isn't building you any wealth. You're driving around in a car that's losing value every single day. I mean, eventually that car is going to be essentially worthless. But instead, what if you took this money and you put this money to work for you? Instead of giving it to your car dealership, what if you gave this money to yourself? Maybe what if you just saved that money? Or what if you invested that money into your future to build your wealth? I mean, if you took the same $528 a month and you put this money into the stock market and you could get, let's just say, a 10% annual return on your money, average, which has been around the average historical stock market return for the last century. If you took the $528 a month, I'm not even going to look at the benefits you're going to get from not having such expensive insurance or not having such expensive premium gas. But if you took the $528 a month and you invested this money into the stock market, maybe you just put it into an ETF, giving you exposure to the total stock market, you get a 10% return. You do this for 30 years, you're going to have an investment fund worth over $1.1 million. You drive a car for 30 years, it's going to be worth nothing. In fact, what's going to happen is you're going to pay this car off after 6 years, and then you're going to feel weird not having a car payment. So then you're going to trade that car in, get a new car with a higher car payment, higher insurance, and now your payments slowly start to go up every 5 years. You have a higher car payment, then a higher car payment, then a higher car payment, because cars keep getting more expensive. Then you're going to say, but Jaspreet, I need a car to get to work. I need a car to pay for my bills. I need a car to do my things. How am I going to do that if I don't have a car payment? Well, you put $8,000 down to go and buy this car. Instead of taking the $8,000 to put it as a down payment for your car, take the $8,000, go out and buy a used working condition car. Maybe you're not going to get a nice BMW anymore, but you can get a used working condition Toyota Corolla, maybe a Toyota Camry, and now you got a car that uses regular gas, that has cheaper maintenance, that has cheaper insurance, and that doesn't have a car payment. And now you don't look like that cool person in the new car, but you have real wealth being built. And then as you start to build this wealth, well, then you can start to go out and buy the nicer cars without having a car payment. Because when you finance your car, not only are you paying interest on this car, but you're paying interest on a car that's losing value each and every month. And rule number 1 to building wealth is you don't want to pay interest on something that's losing you money. You want to be earning money and using your money to live your lifestyle instead of working your job to pay for interest on a depreciating liability. What wealthy people want to do is they want to own assets to pay for their depreciating liabilities, because now your money is working hard to buy you all the dumb and expensive stuff. But while most people are doing the opposite. Most people are working hard. They're working hard at the job to earn money. That way they can drive around in the expensive dumb stuff. Nothing wrong with having expensive dumb stuff, but you want your money to pay for that for you. You want the money that your money earned to pay for that for you. But you are working hard to buy expensive dumb stuff. Well, that's not a very good arrangement. And that's why you want to switch the way you look at money in driving your car. Habit number 2 is you treat your home like a savings account. The average American will tell you that the home that you live in is your biggest and best investment that you can make. And I understand, because I am a licensed realtor. And when you become a licensed realtor, one of the things they tell you when you learn how to sell homes is that you're selling a great investment. This home that you live in is an amazing investment, because if you go out and buy this home for $500,000 today, you can add more money into the kitchen, into the basement remodel, into making the bedrooms and bathrooms nicer. And maybe when you go to sell this home, you're going to be able to sell it for, I don't know, $650,000. Or even if you don't sell this home, well, you can pull this new cash out of your home through an equity pullout, through a cash out refinance. This equity is wealth that you are building, not just for yourself, but for your children and your grandchildren, because one day you'll be able to pay off this home, and now you have this amazing asset. Well, let's talk about this, because the home that you live in is really not a true asset. Because why are you buying the home to live in? I mean, you're not buying this home to make money. You're buying the home to make memories. You're buying the home to actually use. And if you're buying the home to actually use, that's going to be a very different financial decision versus buying something like a rental property to make money. Because when you're buying something to make money, you're going to look at it very differently versus when you're buying something to actually live in yourself. And now, when you buy this home to live in, you have to pay money to live in here. How do you make money to live here? Well, you got to go to work to continue making payments here. So you're going to work to make the payments here. You're the one that's working to pay down the mortgage. And then on your mortgage, if you get a 30-year fixed rate mortgage, the first half of your mortgage, actually the first 14 years of your mortgage, more than half of your monthly payment is going directly into your banker's pocket with interest, because your mortgages are front-loaded. Your banks want to get paid before you get paid. So during the first year, when you're paying your $2,000, $3,000 a month in your mortgage payments, almost all of your mortgage payment is being used to pay your banker's interest, as opposed to building any equity in your home. I mean, if you look at the principal balance of your loan, what you'll see is in the first few years, you barely make a dent in the principal balance. And the reason why is because your loans are front-loaded. Your bankers want to get paid before you do. And then not just that, you got to pay for the property taxes. Then you got to pay for the HOA. Then you got to pay for the water bill, the electric bill, the gas bill. And then when you upgrade the property, you got to pay for that too. And when the window breaks, you got to pay for that too. And when the roof gets old, you have to pay for that too. And then you have to hope that 10 years from now, when it comes time for you to sell the home, that you can sell it for a profit. And then if you start following your banker's advice, well, if your home goes up in value, then you can just pull the cash out and use the money to buy a car. You can use the money to go on a vacation. You can use the money to go and spend. But when you use the money, again, to finance more liabilities, you're using tomorrow's income to fund today's expenses. Because when you use this equity to go out and fund your vacation, that $10,000 vacation that you just bought has to be paid back with interest. Well, how are you going to pay this back? You're going to pay it back by going to work. And so now you get stuck in the cycle. You get stuck in the system. You have to go to work to get paid. Why? Because you got to keep paying back your bills. Now, I'm not saying it's bad to own a home. There's nothing wrong with owning a home. But you have to understand that your home is not a savings account. Your home is really not the best wealth building tool. You don't hear a wealthy people talking about how I became so wealthy because I paid down my home. No. Wealthy people become wealthy because they build a business, or because they buy a business, or because they invest in stocks, or because they invest in rental properties. They don't talk about how they became wealthy because they paid down the equity in their home. They talk about how their home is an expense, about how you have to pay for all these expensive things to continue funding your home. Maybe you'll be able to sell your home for a profit, but if you sell your home for a profit, you no longer have a home. And this is where now you have to understand the difference between using your home as a savings account and just owning the home that you live in. Treat your home like a liability, because if you do that, you're not going to stretch yourself too thin. You're not going to stretch yourself too thin. That way now you own a home, but you have no more money to invest. And that's what ends up happening to so many Americans. Is you go out and you tell yourself, and your banker's going to tell you the same thing, your realtor's going to tell you the same thing, your parents and your friends are going to tell you the same thing, that your home is the best wealth building tool and you have to own your home. And when you do that, now you might go out and stretch yourself a little too thin because now you want to have the dream home because it's an investment. I mean, why not? So now you go out and buy this dream home, and then you have no money left over every single month because you're spending all your money in your home. And now you don't have any money to put into the stock market. You have no money to buy a rental property. You have no money to start the business idea. You have no money to invest into other business ideas. And now because you have no more money to invest, all your money is being sunk here into this money pit, which you thought was an asset, that you thought was an investment, that you thought was a good financial decision. But in reality, it's just pulling money out of you. A real investment is something that will pay you as opposed to something that you have to pay for. And now, if now you took the same money and you went out and you bought a rental property, now this rental property is going to be the one that's paying for the mortgage. Your rental property is going to be the one that's paying for your utility bills. Your rental property is going to be the one that's paying for the upgrades. Your rental property is going to be the one that's paying for the property taxes. And the rental property is going to be the one that's putting some money in your pocket every single month, as opposed to this, you are the tenant. Yeah, you own the home, but you're the tenant that's got to pay for all the expenses. Now, I'm going to say this one more time. Nothing wrong with owning a home. I actually like home ownership. I like the idea of you owning a home, but I want you to be a smart homeowner as opposed to somebody who's thinking that this home is the best investment that you can make, and now you go deep into debt to buy a home that's way beyond your budget, and now you have no more money to actually invest into real assets that will actually make you wealthy. Number 3 is you wait too long to start investing. If you want to build wealth, there's 3 things you got to pay attention to. TRD. Time, return, and dollars, period. If you use any compound interest calculator, if you use any wealth building calculator on the internet or anywhere, what you'll see is that the 3 questions that any calculator will look at to see how wealthy you will become is how much time do you have for your investments to grow and compound? What is the return of your money, meaning how fast can your money grow? And how many dollars are you going to invest? The more dollars you invest, the wealthier you become. The more time that you have invested, the wealthier that you'll be able to become. And the faster your money grows, the wealthier you will become. Now, when it comes to time, what do any of us think is, okay, you know what? I just graduated college. I want to go buy a new car. I want to get myself an apartment. I want to go on a vacation. I don't want to start investing yet because I finally am starting to make some money. So let me just start going out and enjoying my time. Let me just start enjoying my money. Then you turn 25 and now you start to have weddings to go to. Some of your kids start to have baby showers. You start to think about your own wedding process. And now you're like, you know what? I'll start financially planning when I get closer to getting married or when I want to go out and actually start my life and settle down. Now you hit around 30 and you start to get married, or you're around the time of where you're getting married. Now you got to plan for the wedding. That has a cost. So you know what? I'm just going to hold off on investing until I'm done with the whole wedding costs and buying our first home together and buying our first car together, because that's just really expensive. And then now it's finally time. You're in your 30s. You're ready to start investing and start settling down. But then you think about having kids. And kids are expensive. You got to think about childcare. You got to think about what are you going to feed the kids. You got to think about your kids' clothes, you think kids' schools, and all these things have a cost. And maybe you start investing a little bit in your 401k because your friends are doing it, but you keep putting off this idea of investing more because you have all these expenses that keep adding up. And then you turn 35, and then you turn 40, and everything keeps happening. Your kids have friends who have birthdays. Your friends have baby showers. You have weddings to go to. You got trips to go to. You got bachelor parties to go to. All these things are expensive. And one of the most important factors, I mean, you got 3 factors that will determine how wealthy you will become. You cannot change time, but you can change the return, you can change the dollars. But the one factor you cannot change is time. And this is why it becomes incredibly important for you to start investing sooner rather than later. Even if you don't have a lot of money to invest, well, guess what? If you can start at the age of 21 with $100 a month, that is going to be extremely powerful. And this is where now make a little bit of a sacrifice to start investing sooner rather than later, because this money will have more time to compound. And the more time that your money has to compound, the wealthier you will become, period. You don't even have to know how to invest. Just start throwing some of your money into the stock market. I know you don't want to do that, but just start. Because the more time that you have to invest, your knowledge is going to compound, your money is going to compound. Yeah, there will be times where you lose money. There will be times where you go through a market crash. There will be times where you go through a recession. This is a part of our economic system. But your money has to have time to grow. And you cannot go back in time to start investing 5 years ago. You can work to improve how many dollars you invest. You can work to improve your financial education, improve your returns, but you cannot change this time, which is why you have to get started with investing sooner rather than later. Now, if you're looking for some additional resources on how to start investing and the financial education, my team at Briefs Media put together this amazing ebook on how to build wealth as an investor. And this starts with the basics of how do you build the mindset of an investor, to how do you save your first couple $1,000s, to then how do you start investing, to the different ways to invest your money. What is investing for cash flow? How do you invest for cash flow? What is investing for appreciation? Then we go over things like how do you spend your money smartly, to how do you earn more money smartly, to how do you protect your assets. This ebook is completely free and it is packed with value. So if you want to get a copy of this ebook for free, all you got to do is click the link down in the description below or go to briefs.co/ebook. Number 4 is you act like an influencer. The difference between a social media influencer who's showing off their fancy brand name stuff and a random person on the internet who's showing off their brand name stuff is that the influencer is generally getting paid. When the influencer is getting paid by Gucci and Louis Vuitton and Lululemon to wear that stuff, they're getting paid to wear this stuff. They're getting paid to wear the brand name stuff. It's an investment for them because it's putting money in their pocket. When you go out and you buy Gucci, you buy Lululemon, you buy the Louis Vuitton, that stuff that you're buying is not an investment for you. It's an investment for Gucci, Lululemon, and Louis Vuitton because they're the ones that are getting paid. And so if you're not getting paid to wear the Nike, if you're not getting paid to wear the Lululemon, if you're not getting paid to wear the Gucci, it's not an investment for you. Now again, nothing wrong with buying the stuff, but you gotta understand where in your financial journey that you are. If you're struggling to pay your bills, if you don't have any investments, if you're not generating any cash flow, if you don't have any dividends, if you don't have any rental properties, and you got all the brand name stuff, your priorities are in the wrong place. And you got to remember now, what is an investment versus not? If you are an influencer and you're getting paid to wear the Gucci, that's an investment for you. If you're not getting paid to wear the Gucci, it's not an investment for you. Number 5 is you're counting pennies, not dollars. I was in Europe recently because I was invited to speak, and while I was there, I had some time to kind of roam around. And while I was there, I met a couple from America who recognized me. They came up to me and told me how they were on this beautiful vacation in Europe, checking out all these different countries. I think it was like a 14-day vacation throughout Europe, and I said that was amazing. And the couple asks me, because they had this debate between the husband and the wife, which was essentially, what are my thoughts on Starbucks? Because the husband and the wife are debating on whether it's a good idea or not to spend $4 a day on Starbucks. One of the people, I think it was the husband, was upset that the wife was going to Starbucks every single day. And they were talking about how much money they were spending on Starbucks and whether this money would have compounded and grown to actually build wealth. And the funny thing was, I looked back at them and I asked them, how much money do you think you spent on this vacation? I think they told me $15,000 on this 2-week excursion through Europe. And you're asking me about $5 at Starbucks, if that's going to make a difference in your life. Because over the course of a year, $5 at Starbucks every day is about $1,500, and you spend 10 times that on this vacation. So now the question is, where are the bigger money questions? Is it Starbucks that's keeping you struggling financially, or is it a bigger question? Is it the expensive apartment that you have? Is it the expensive car that you drive? Is it these $50,000 questions, or is it the $5 a day question? And this is where now you got to just be honest with yourself. You got to know how much money you can spend. Is it the $5 things that's keeping you broke, or is it the $50,000 things? Is it the job? Is it your car? Is it your apartment? Is it some other expensive decisions, or is it the $4 or $5 that you're spending on that coffee? Number 6 is you buy what you deserve, not what you can afford. I already gave this example in a previous video, but I'm going to give it again here because I think it's very fitting. There was a news story here in Detroit about a lady that was being interviewed because her water was being cut off because she wasn't able to pay her water bill. Now, it was a very sad story because she was talking about how she no longer had the money to pay her water bills, so she didn't have money to give her kids water and all that. But the people that were giving her the interview, because you saw her on camera, showed that she had AirPods in her ear, the 2nd generation AirPods. She was holding the new iPhone 14 or 15 or whatever it was in her hand, and she had Jordans on her feet. And so you could see kind of the comments of people talking about, wait, you have all these expensive things that you're wearing, and you don't have money to pay your water bill. Now, this might make some of you upset, but I'm going to be as real with you as possible. Nobody really cares about how you feel. We live in a society where it's very social media attractive to be kind of a victim. in situations where, oh my God, I'm being abused, or oh my God, I'm being taken advantage of, or oh my God, I am losing in a situation. However, at the end of the day, it's not about how you feel, it's about what actually happens in your real life. And when it comes to money, that means if you're spending money on things that you deserve because you work so hard, so you deserve that Gucci handbag, or you work so hard, so you deserve to drive this nice car, or you feel like you finally deserve to have this dream home, but your bank account feels differently, well, guess what? You can go out and buy all that stuff. It's easy to buy things because of our society. It makes it very easy to buy things with easy lines of credit. It makes it very easy to buy things with buy now, pay later, or as I like to call it, broke now, broke like later. Or as I like to call it, broke now, broke later. And it's very easy to buy things because of credit cards. But in reality, if your bank account can't afford it, you're going to be the one that pays the price. People prey on your emotions. They prey on you being able to go out and deserve these nice things, to just go out and buy things and treat yourself. It's good for the corporations. It's good for the banks. It makes for great advertising, and it makes you feel good in that moment. But the reality is, and people don't want to say this because it hurts people's feelings, you can't. You can't afford that. And that's more difficult to say. And it's very hard for people to accept that because no one wants to hear no, especially in today's society where everything has to be kind of like softened and molded and sugar-coated. But the reality is, well, if you're broke, you should not be buying these nice things. If you're broke, you got to stop spending money on things that you feel like you deserve. And if you're broke, you got to make financial changes. You have to make financial sacrifices. And this is tough for a lot of people to hear, but this is the reality. Because at the end of the day, sympathy is not going to pay your bills. Sympathy is not going to pay your credit card bills. Sympathy is not going to pay for your rent. Sympathy is not going to put food on the table. But knowing how to spend your money will. Knowing how to spend your money will allow you to invest. Knowing how to spend your money will allow you to live below your means. Knowing how to spend your money will allow you to live financially comfortably until you have more money to live larger. And this is where you got to stop living in your feelings. That's hard in today's society, where everybody wants to cancel everybody who talks. And this is where honestly just understand what's real and understand what's right for you and look at your bank account. If you can afford it, you can afford it. And a simple rule of thumb here, because there's a difference between being able to buy something and being able to afford something, which is if you cannot buy 5 of them, you cannot afford 1 of them. And the 7th habit that keeps so many people broke is having a broke mindset. And you can see this all over the internet. Anytime you hear of articles, and there's a reason why Forbes and Inc. magazine and all these agencies publish articles that say things like, here's a list of the richest people in America who don't want to pay taxes. Here's a list of the wealthiest people in America who own more wealth than 50% of the population. There's a reason why they say things in a certain way. It's because they want to incite emotion. They want to get people riled up. They want to create the us versus them, because that makes more money for these agencies. And what you want to understand now is not trying to hate and get caught up in the emotions, because the emotions drive money for the media agencies. What I want you to do is cut through the noise, cut through the emotions, take a deep breath, and now understand, how does this play a factor for you? Because a lot of times, if these things don't really affect you, what I want you to do is look at how can you learn from it? Because if you can learn how to learn from it, now you will be able to ask the question of, how did they become successful? How did they become wealthy? What did they do? What can I apply to my lifestyle? And when you get caught up in this emotional social media rage, because that's what, it's very easy to do. Media companies are spending a lot of time, a lot of money, and a lot of energy to incite that, because that's what makes them more money. What I want you to do is don't give in to that, but now understand, how do you win in this financial system? And that means not hating the success, but rather understanding the success and see how you can apply that success to your life. Because at the end of the day, that emotion is not going to pay for your bills, but the financial success, that money in the bank, will. There's a couple big ways that you can invest in real estate without actually owning and operating your own rental properties. One way is by investing in crowdfunded real estate, and another way is by investing in REITs, or real estate investment trusts. And in this video, we're going to be talking all about how you can make money by investing in REITs. Crowdfunded real estate is when you and a bunch of other people invest your money into a fund that gives you exposure to a handful of real estate properties. You cannot invest in crowdfunded real estate on the stock market. You have to typically use a crowdfunding service, and once you invest your money into a crowdfunded real estate fund, you're not going to get your money back typically for years. years. A REIT is a real estate investment trust, and this is where you are investing into a company that's investing into real estate investment properties. Unlike crowdfunded investments, you can invest in REITs on the stock market, so you can buy and sell REITs whenever you want. If you're subscribed to this channel, you know that I love investing in real estate. If you're not subscribed to a channel, you should probably do that, but I invest in rental properties, I have invested in crowdfunded real estate and REITs, and all of these real estate investment options have their own pros and cons. This video is all about investing in REITs. Now, while I'm not going to go over crowdfunded deals in this video, if you do want to learn more about crowdfunded real estate, I have an article on our website where our team goes over everything you need to know about investing in crowdfunded real estate deals, and if you want to read this article, you can do it on our blog by clicking the link up here, and I'll also link it for you in the description below. The reason that people love real estate as an investment is because you can create, for the most part, predictable passive income. You buy a property, and to keep things simple, let's say you buy a house for $100,000, and then somebody moves into this house, a tenant, and this tenant is now going to pay you $1,000 a month every month for living in your house. But buying and operating your own rental properties is a little bit more extensive because one, you need to have access to the cash to buy the property, and two, you need to have the team built. So that means you need to have access to the real estate agents and the contractors and the attorneys and the accountants and the property managers, so it's more involved. This is where REITs come in handy because you can invest in a REIT, which is a company that is now going out and investing in real estate and making money through rent. The cool thing about REITs is that they are required by law to pay out 90% of their taxable income or their rent to you, shareholders, through dividends. REITs make money by buying real estate properties and then leasing them out to other people. That way they make rent. So now they take all this rental money that they get and they pay their bills, and now they take 90% of whatever money is left and they have to pay this money out to you and other shareholders through dividends. A dividend is a cash payment that a company gives you. So now instead of you going out and getting rent from a tenant, you are investing in a company that's going to manage the property and do all the work, and this company is going to pay you a share of their profits through dividends. REITs are a popular way for you to invest your money if your goal is passive income because REIT stocks tend to pay much higher dividends than regular stocks. Some REITs pay 10% dividends. That means if you invested $100, you will get $10 back this year just through dividends. But before you just jump in and invest in a REIT just because they're paying a high dividend, there are three things that you need to know. You need to know how dividends work, you need to know what kind of REIT it is, and you need to know what this REIT invests in. Before I get into what these three things are, I need you to do me a quick favor and smash that thumbs up button below, because if you don't, well, the way the YouTube algorithm works, if you do not hit that thumbs up button below, then YouTube will be much less likely to show our financial news and education videos to you and everybody else. When you invest in a high dividend paying REIT, what you'll typically see happen is that when a dividend is paid out, this is called the ex-dividend date. So when the dividend is paid out, you will typically see the stock price of the REIT fall by the amount of the dividend. So if a stock is trading for $200 a share and it pays out a $20 dividend, you will many times see the stock fall to $180 a share the day that the dividend is paid out. If it's a really strong REIT, you'll see the stock price climb back up because investors will use this dip as a buying opportunity to buy the stock. And when it comes to dividends, we have to talk about taxes. Dividends that you get from REITs are typically taxed differently than the dividends you get from regular stocks. Typically, if you go out and you buy a stock and this stock pays you a dividend, you get to pay a very low tax rate on this dividend called the long-term capital gains rate. This long-term capital gains rate is usually a lot lower than the tax rate you pay on the money you make from your job, which is called ordinary income. Well, the IRS says that you have to pay taxes a little bit differently when it comes to REITs. The government said, okay, because REITs pay out higher dividends, it's almost like another income stream for you, so we're not going to give you the long-term capital gains rate, which is a special lower tax rate. You have to pay the ordinary tax rate, which is the higher tax rate on REIT dividends. If you have an accountant or a tax software filing your taxes for you, this isn't really something that you have to worry about too much when you're filing your taxes because this should automatically be calculated. This is more something I just want you to be aware of so you understand how the tax game works. Now, I also do have to tell you that while I am an attorney, I'm not your attorney, so if you have specific tax questions, make sure you talk to a tax professional in your area. Now, let's move along and talk about the different kinds of REITs, because you have two different kinds of REITs. On one hand, you have equity REITs. These are REITs that go out and they operate and they own real estate investments and they have tenants that pay them rent. Then there are mortgage REITs, which invest in loans and mortgages. These mortgage REITs make money when landowners and property owners pay interest on their debt. Both type of REITs come with their own fair share of risk. I mean, the mortgage market is going to go through their own cycles, just like how the real estate market is going to go through their own cycles. And some mortgage REITs are going to invest into more risky loans, and some equity REITs are going to invest in more risky properties. You got to know what kind of investment you want. Being a mortgage REIT or an equity REIT doesn't necessarily change much when it comes to researching a REIT. It changes more of how the company operates. Like AG&C, which I talked about earlier, was a mortgage REIT, and SPG, which I also talked about, is an equity REIT. Again, I'm just giving you these REITs as examples. I'm not telling you what to invest in, but once you understand what the different kinds of REITs are, that's when you can look at what these REITs actually invest in. Some equity REITs, so these are the REITs that own and operate their own real estate, will invest in residential real estate, so apartments and homes. Other REITs will invest in hospitals. Other REITs will invest in office space. Other REITs will invest in malls. Ask yourself, if you had an unlimited amount of cash, what kind of properties would you want to own? You do not, I repeat, you do not want to buy into a REIT just because they're paying out a high dividend. A really high dividend yield could mean that a company is making a ton of profit and the stock price hasn't caught up to it yet, which is good. And it could also mean that the stock price is tanking because the company is having a problem and the dividend hasn't adjusted yet. That is bad. With mortgage REITs, you got to look at the same thing. Some mortgage REITs will invest in mortgage-backed securities. Some will invest in commercial loans. Some will invest in commercial mortgage-backed securities, and others will invest in high-risk mortgages. The mistake that a lot of people make when they invest in REITs, and this happens for any stock for that matter, but especially in REITs, is that they think that they're investing in a ticker symbol as opposed to a company. They think, wow, this stock is paying out a 10% annual dividend. Let me just throw all my money into the stock because I'm going to make 10% of it back every single year. But if you're getting a 10% annual dividend while the stock price is falling 20% a year, you are in a losing situation. But if you know what you're doing, you have the opportunity to win twice, because now you're going to invest into a strong company, which means your dividends are going to go up because they're making good acquisitions, and the stock price is going up because the company is becoming more valuable, so now you're winning twice. Now, if you've made it this far in this video and you're thinking to yourself, man, I would really like to invest in REITs, but I don't trust myself to do the research, or I don't know how to do the research, or I just don't want to spend the time doing this research, then you may want to consider investing into a REIT ETF. An ETF is a fund that invests in a whole bunch of different stocks. So now, instead of you going out and trying to find the best REIT to invest in, you can invest in a REIT ETF, which is an ETF which invests in a whole bunch of different REITs. This would be like investing in VNQ. Again, I'm not telling you what to buy, just giving you an example. VNQ is an ETF that invests in REITs. So now, if you bought shares of VNQ, you will have exposure to 180 different REITs, because VNQ is a fund that invests in more than 180 different REITs. So REITs are a way for you to get exposure to the real estate market without having to actually manage and operate your own real estate investment properties. And unlike crowdfunding, REITs allow you to access your money whenever you want. If you want to save your first $100,000, you don't need to live like you're broke and only eat rice and beans for the rest of your life, but there are 5 things that you need to do when you get paid in this order. That way you can save that $100,000 sooner rather than later. The first thing that I want you to do is to create 3 separate bank accounts. And the reason why I want you to do this is because each one of us have different things that we're good at. Like, for example, me, I'm good at how I spend my money. I can control my spending very easily, but I'm not very good at controlling my eating. I like food. When there's food in front of me, I'm going to eat it. So in order to stop me from eating, I don't have the food in front of me, or I'll just eat whatever's there. So I've learned about me that some people are very good at eating, that when they start eating, they can stop themselves before they're full. When I start eating, if there's food there, I will eat it. But when it comes to spending, I'm a much better controlled spender than I am when it comes to eating. So if you want to control your spending, the first thing that I want you to do is create 3 separate bank accounts. One bank account is going to be for your spending money. One bank account is going to be for your investing money. And one bank account is going to be for your saving money. And the reason why you want to do this is so you don't accidentally spend your investment money, or so you don't accidentally spend the money that's supposed to be saved, because now it's out of sight, out of mind. And now what you want to do is anytime you get paid, your money is going to go here. But then as soon as your money goes into this bank account, you want to automatically take some of this money and move it into this bank account, and automatically take some of this money and move it into this bank account. Many banks will automate this process for you for free. If you don't have a bank that allows you to do that, maybe you look for new banks in your area that will allow you to do that, but a lot of banks will allow you to create an automation like this completely free. And now you have a system of knowing this is the money that you can spend. If there's no money in here, you have no money to spend. The second thing that I want you to do is know how much money you can spend versus invest and save. And a simple place to start is something like my 75-15-10 plan, which says that from now on, for every dollar that you earn, 75 cents is the maximum you can spend, 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. Now, if you're watching this saying, but Jaspreet, I'm spending 100% of every dollar that I earn. How am I supposed to now take some money aside and use it to invest or save because I don't have some extra cash? Well, I want you to think of it this way. If the government tomorrow announced that there's going to be a new 25% tax on your income, what are you going to do? You're going to kick, scream, complain, cry, and then you're going to figure out how to pay it. Same thing here. Now what you're doing is you're not giving money to the government, you're giving money to yourself to make yourself rich. Because now what wealthy people do, and what you're going to be doing, is you're going to pay yourself first. And by paying yourself, I don't mean going out and buying a new Gucci bag. I mean now using money to make yourself wealthy. Your investments are here to make you wealthy. Your savings are here to protect you against a financial emergency. The spending money is there to allow you to have the nice things, go on the nice vacations, eat at the nice restaurants, buy the nice cars, but this money is not going to make you rich. This money will make you rich. This money will protect you financially. This money will allow you to live your life. But you need to make sure that now you're not spending all of your money here. That way you always, no matter what, pay yourself first. You're always going to be investing your money because this is where you're going to build your wealth. Now, if your goal is to put aside $100,000, let's talk about what this actually means, because if you're making, let's just say $50,000 a year, and now you're going to be putting aside 25% of your income, some of it's for investments, some of it's for your savings to build your wealth. That means that right now you're going to be putting aside $12,500. At this rate, if you put aside 25% of your income, assuming you don't get a pay raise, because if you get a pay raise, you're going to be investing more money and saving more money, because now when you get a pay raise, your investments also get a pay raise. But if you don't get a pay raise and now you're putting aside 25% of your income, well, it's going to take you 8 years to have that $100,000 put aside. Now, some of this is going to be in your savings account, some of this is going to be in your investment account, but now you have a solid plan on how you can put aside $100,000 in not that long of a time, assuming you don't get a pay raise, but there's more. Number 3, if you want to accelerate how fast you can put aside this $100,000, you can also let your money make you money. Because now when you're putting your money here to invest, this money is supposed to grow. Now, this doesn't mean it's necessarily going to grow by a certain percentage every single year, but you're putting this money aside here. That way it gets bigger. That way your money is making you money here. The money here in your savings account probably isn't going to grow much. Sure, maybe if you put your money in a high interest savings account, you might get some return on your money, but this is where you really want to see your money grow. And if you know how to invest your money the right way, now not only are you putting money aside, but your money is going to be working to grow as well. That way now you're working to get a raise. That way you can give a raise to your investments and you can get a raise to your savings, but then your money that you put into this investment account is also going to be working to grow as well. That way this can grow even quicker, so you can hit this goal even faster than 8 years. The 2 most common places where you can invest your money are into stocks and then into real estate. So let me talk about both and talk about the different ways that you can invest your money and different ways that you can actually get a return on your money. When you invest your money into the stock market, you're investing your money into a company. You're literally buying a piece of a business. Like if you go out and buy 1 share of the Amazon stock, you become one of the owners of the Amazon company. Now, the thing that I want you to understand here, that you don't have to go out and find the next Amazon or the next Google in order to make a lot of money. And this is the first mistake that so many people make when it comes to investing their money in the stock market, is they think they have to find the next hot stock. But the reality is, for probably 90 to 95% of people, you shouldn't be investing in individual companies. Why? Because most people don't have the interest or the education or the psychology to actually invest in individual companies. Because the reality is, when you invest in individual companies, if you really want to make money,
you have to first understand, how do you actually analyze the company? What research do you do to keep up with the company? How do you keep up with the numbers? How do you keep up with what the management's doing? How do you listen to the earnings calls? What information should you be paying attention to? Most people don't care about that, and if you do care about it, well, a lot of people don't have the education or care about putting the education in to actually do that. And then if you are willing to do that, the next group of people don't have the right psychology to actually manage their investments, because the reality is market crashes happen. You're going to see booms and busts. And what ends up happening now to most people is they end up losing money in the stock market, when historically over the last 100 years, the stock market has gone up over the long term. Why? Because most people start selling and panicking when the market goes down, while smart and savvy investors are buying. And it's not easy to now actually do it. It's much easier to say it than actually do it, because now when you see your portfolio in the red, it can be very scary, and most people tend to panic, and then they make decisions based off of emotions, not financials. This is why most people shouldn't be going out and buying stocks, when the next best thing is buying something like a fund, potentially an index fund or an ETF. This is where now you're not investing in individual companies, you're investing into a group of stocks. That way now you don't have to worry about doing the research in individual companies. You don't have to worry about keeping up with all the companies. And now you just want to create a system where you're automatically buying some of these funds over the long term. Every week, every 2 weeks, every month, no matter what, you're just going to keep buying. If the market's booming, you keep buying. If the market's crashing, you keep buying. The only change that you'd make is maybe you buy even more when the market is crashing, because it gives you the opportunity to buy even more at a discounted price. Now I'm going to go over a few fund examples, but I want you to understand that, one, I'm not telling you what to buy, and two, investing has risks. You're never guaranteed to make money when you invest, which is why you need to always do your own research and never blindly trust a random guy on YouTube. So if you wanted to just invest your money in the stock market, you can invest in a fund like VTI. VTI is the total stock market ETF created by a company called Vanguard. What does that mean? If you go out and invest in the VTI ticker symbol, you're investing in literally the entire US stock market. So if you buy this one fund, you're buying a little piece of a lot of stocks on our stock market, which means essentially if the stock market goes up, your fund goes up. If the stock market goes down, your fund goes down. SPY is another fund which gives you exposure to the S&P 500. That means now you're getting exposure to the 500 largest companies on the stock market. SCHD is a fund that gives you exposure to dividends, dividend-paying companies. Now, I put a little asterisk here because, as a disclaimer, I do own SCHD. And so now the question is, how do you want to get paid, and what is it that you want to invest in? If you just want to throw your money into the stock market, well, VTI can give you that exposure. If you want to invest your money into the biggest companies in the stock market, SPY gives you that exposure. If you want cash flow, SCHD can give you that exposure. Now, this is where you have to start thinking, what type of investments do you want to make and how do you want to get paid? Because most people think of investing as, I'm going to put my money into this thing and then I'm not going to see this money until I'm 65 or 70 years old. I like to look at investing like, I want to invest my money into something and start generating some cash flow now. That's why the bulk of my investments, not all, but about 75% of my investments are cash flow producing assets. That means that I buy something and it pays me with cash flow. So the bulk of my stock market investments pay me with cash flow. The bulk of my real estate investments pay me with cash flow. I like cash flow just because it gives me cash in my hand today, and I can more reasonably predict how much cash flow I'm going to get, as opposed to how much a stock or how much a real estate property or how much a business is going to be worth at some point in the future. If property prices and stock prices go up, that's icing on the cake. But I just want that cash flow, because the cash flow gives me cash that I can use today. And now if you're working to build up $100,000, that cash flow is putting more cash in your account, or that cash is being used to buy you more shares. Because for me right now, with my stock market investments, the things that are paying me cash flow, I'm not using that money. I'm taking that cash and I'm reinvesting all of it. So I get the cash flow from my investments every 3 months, because I get my dividends every quarter, meaning every 3 months. And then this money goes right back into the market to buy me more cash flow producing assets. So every week, the way it works for me is every week I have cash going into my funds. Then most of these funds are paying me with cash flow, which goes back into these funds to buy me more cash flow producing funds. So it's like a machine that's working to produce more cash flow while I'm throwing more money in there to buy more of the cash flow, which brings me to number
number 2, which is real estate. Real estate is one of my favorite places to invest because when you invest in real estate, now you're buying something tangible. You buy something that you can see, feel, and touch. You buy the bricks, you buy the land, you buy the windows, you buy the doors, and then you can also create cash flow. So now the way it works is you're gonna go out and you're gonna buy this property and then you're gonna rent it out to somebody else, and then somebody, that's supposed to be an arrow, somebody is gonna come in and live in this property and they're gonna pay you rent. Now if you do this the right way, this rent should cover all of your expenses. That includes your property taxes, your insurance, your maintenance, your management fees, and cover your vacancy costs and cover any debt that you might have, and then put some money in your pocket. Now, does this mean that every real estate deal is going to be profitable? No. This is where the research comes in because, well, right now you have a very hot real estate market, which means it's harder to find a good cash flow producing deal. Does that mean that there's no deals out there? No, it means you got to be pickier and you got to work to find the good deals. And this is where, again, that financial education comes into play. Now, should everybody be a real estate investor? Of course not. But it creates opportunity for the right people. Now, if you don't want to go and actually invest in real estate, there are funds that you can put your money in that will give you exposure to real estate properties. I have an example of one of my affiliate companies that allows you to do this down in the description. But this is where just understanding that you can get cash flow from different places, and then if real estate prices go up, well, that's icing on the cake. If real estate prices go down, well, at least you're still getting that cash flow. This is now where you have to make that decision of how do you want to invest your money. Do you want to invest your money and see the future growth, or do you want to invest your money and see the cash flow? For me, I like cash flow. That's why the majority of my investments are cash flow producing, and some are not. But you got to figure out what are the right investments for you. That way now you're working to put that money aside, but then your money is also working to make you more money. Now, if you want to go step by step on how do you actually make your first investment, how do you step by step start generating cash flow, even if you don't have a ton of money, we have a free ebook that we put together in Market Insiders that goes over how you can make your first investment, what investing is, how you can get started with investing, and how you can start generating cash flow. It's completely free, so if you want to read this ebook, I'll link it for you down in the description below. Number 4, I want you to manage your 2 S's, which is your spending and your saving. And I'll start by talking about saving because the reality is your savings are not going to make you wealthy, and your savings are probably going to lose value to inflation. If the interest rate that your bank is paying you is lower than what inflation is, your savings are effectively making you poorer. Now, that being said, that doesn't mean you shouldn't have any savings. That means you need to save your money strategically. That means you want to have somewhere between 3 months and 12 months worth of expenses saved up. Now, I know this is a big range, and the reason why it's a big range is because, well, it depends on where you are in life. If you're young, you don't have any financial responsibilities, you have more freedom to be more risky, and maybe you can take on more risk, which means you might only need a few months worth of expenses saved up. If you have kids, you have a spouse, and you're not really open to this whole idea of taking risk, and you don't like this idea of investing your money, and you feel safer with the cash cushion, then maybe you have somewhere between 6 and 12 months worth of expenses saved up. You got to find what's the right number for you, but somewhere between the 3 to 12 months of savings saved up here. Once you build that savings cushion, now you're no longer going to save money, and you're going to reallocate that money here towards your investments because your investments are what's going to make you wealthy. But in order to do this, what I want you to do is look at your credit card statements, look at your bank statements, see how much money you're spending every month. Add up your rent, your mortgage, your utilities, your car payments, your car costs, your gas, your food, your eating out, your travel, whatever your costs are. Multiply the number by 3, multiply the number by 12, and that gives you a range of how much money you need to save. Once you hit that number, well, now you can stop saving that money. You can leave the bank account there because this is your cushion. Then you can start investing that money. The second S that I want to talk about, though, is how you spend your money. Because a lot of people assume that if you can buy something, that means you can afford it. But the reality is being able to afford something is very different than being able to buy something. Because if you have $100 in your account, you can go out and buy a $500 phone. But the reality is you can't actually afford that $500 phone or the $500 Gucci belt or $500 whatever, because financing doesn't mean that you can afford it. See, when most people think of affording something, they think I can just afford the payments. But now if you really want to become wealthy sooner, and if you really want to achieve that financial success that you want sooner, and you want to have to stop kind of spinning your wheels in this financial system sooner, you got to stop playing in the same game as everybody else. And that means you're going to have to control the way that you spend your money. And that means from now on, if it doesn't put any money in your pocket, don't use debt to buy it. The only exception to this would be the house that you live in. But if it's not putting any money in your pocket, don't go into debt to buy it. So what does that mean? You want to go out and buy a new car? Great. Don't get a car payment. If you want to lease a car, okay, well, you got to be really rich to be able to do that. Leasing a car is like going and flying first class. Flying first class and sitting economy is going to get you to the same place, but flying first class is a whole lot more comfortable. Leasing a car is very comfortable. It comes with a lot of perks, but you got to have the money to be able to actually afford that. That means if you can't afford to buy the car comfortably with cash many times over, don't even think about leasing it. So if you want to get a car, buy a car that you can afford with cash. That way now you don't have to worry about the monthly payments, because now when you don't have to worry about the monthly payments, all of a sudden you're going to have a whole lot more extra money every single month, because now not only are you not putting the money into the monthly payments, you don't got to pay for the premium gas, you don't got to pay for the expensive insurance, you don't have to pay for the expensive maintenance, and now you have a whole lot of extra money every single month. Yeah, maybe you don't have the BMW anymore, but you still got the extra money which can be used to make you wealthier. And now when you become wealthy, hey, go out and buy the BMW or the Benz, and you don't have to worry about the price. So now we talked about how to spend your money the right way. We talked about how to invest your money, that way you can grow your money. We talked about how to save your money. And this brings me to number 5. If you really want to amplify how fast you can put aside the $100,000 or take it to $1 million or whatever it is that you want to hit, you got to earn more money. Because now if you want more money going into each one of these buckets, you need more money flowing in. As soon as you start doing this, you're going to love the idea of investing. You're going to see the potential growth. You're going to start running the numbers. You're going to say, you know what, this is cool. And yeah, you might start spending less. That way you have less money going out. That way you have more money to invest here. But there's a limit to how little you can spend. But there's no limit to how much you can earn. And this is where things really get fun, because when you understand this, now you're going to be looking for new and creative ways to earn more money. That way you can increase how much money you're putting here, because if you can grow from $50,000 a year to $500,000 a year, now you really can amplify how much money you're spending, investing, and saving. And the first time I say that, you might hear, Jaspreet, where in the world am I going to go from $50,000 to $500,000? Like, that's not even in the realm of possibilities. Well, this is where you have to start thinking a little bit different than what you might have been doing. Because now if you really want to start earning more money, you might have to create your own income. You might have to work to create a side hustle. Start watching YouTube videos on how to earn more money. Start reading books on how to earn more money. If you start opening your mind to the possibility that you can earn more money, now you might start taking actions on how you can earn more money. Because if we just keep doing the same thing every single day, you're just trying to earn more money from your job, maybe you'll get some pay raises here and there, but it's not going to be what you need if you really want to take it from $50,000 to $500,000. And if you want to 10x where your income is, you're going to have to start changing the way you think, and you're going to have to start changing what you do. But in order for you to do that, you have to believe it's possible first. And if you believe it's possible, well, then you're going to start putting in the action to actually make it possible. What are different things that you can do? Well, the internet has made starting a business or creating an income so much more accessible. This could be creating a product. This could be creating your own business. This could be working to provide value to other people on the internet. It could be a side hustle. You can be a freelancer. There are an unlimited number of things that you can do. Now, if you tell me, Jaspreet, I hate the idea of being an entrepreneur. I hate the risk of trying to start my own thing. I hate the idea of trying to manage that type of stuff. Well, that's okay. You don't have to go out and start a business. You don't have to go out and start a side hustle. If you really don't want to do that, then now you want to find a more creative way of how you can earn more money. If you can't do it from your job, if you can't do it from your career, can you add on a second job? If that's not practical either, then how can you increase your income? Can you get a certificate online? Can you get some sort of certification online? Can you do some sort of education that will allow you to earn more money? There's a lot of online certifications that will take some time, that might cost you some money, that will allow you to earn more money. If you can start doing these things and maybe get a new career or find a new job that will allow you to earn more money, now the key is when you get a raise in your income, you don't want to just raise your spending without raising these. That's why we're following a plan that will scale with your income. Because the biggest mistake that so many people make is that as soon as they start to inflate their income, they start to inflate their lifestyle without inflating their investments and inflating their savings. So as you start to earn more money and as you work to earn more money, you got to make sure that you're also increasing this and you're increasing this along with this. That's why you want to have a scaling route where now as you earn more money, you're also spending more, investing more, and saving more. That we're always paying yourself before you go out and make everybody else rich. Dividend, you have to pay taxes on this money. Now you might think, but what if I take this money that I get from my dividend and I reinvest it back into the company, or I reinvest it back into the fund, which is actually a really good strategy when it comes to building wealth, especially as a cash flow investor, because now not only are you contributing more money to buy more of this cash flow, but you're using your cash flow to buy more cash flow.